Hello, welcome to Module 6. We're discussing shares today. Let's get started. There are 3 chapters for this week's work, so that's quite a bit of reading. We've got Chapter 6, which is discussing shares, why we like shares, why they're appealing, describe them from a historical perspective, and it discusses the basic features of shares. So that's what you'll be learning in Chapter 6. In Chapter 7, you'll be learning about analysing them. So the security analysis process. So you'll learn about economic analysis, industry analysis, and have a basic understanding of fundamental analysis. And then in Chapter 8, you're going to be learning about share valuation. So you'll look at the role companies' future plays in the value of the shares and develop forecasts of what the cash flow is going to be from the shares. All right, let's get started. So what are shares? Shares are a little piece of equity in a company. They let us participate in the profits. So remember that shares pay dividends, and dividends come out of the profits that a company makes for the past year. If you are an ordinary shareholder, then you're a residual owner of the company. That means that there's no guarantee that you'll ever receive any return from your investment. If the company goes bankrupt, then you won't receive anything back from the value of your shares. There are preferential shares, which are slightly different, and they get preference. That's why they're called preferential shareholders. But we're talking here about the ordinary shareholders. What they do offer is a chance for us to be able to tailor our portfolios to our individual needs and preferences. So for example, I might have a strong preference for one particular type of share, so I could go and invest in that personally, or I might dislike particular types of shares, so I could avoid those. So you can tailor your investments. Perhaps people need steady income streams, so we looked at that last week with bonds. So with shares, the income stream is less predictable, unlike the bond, but you will still get them from dividends as long as you're choosing shares that pay dividends. Some do not. We're also hoping from our shares that we'll get capital gains and increase our wealth. Doesn't always happen, sadly, but that's what we're hoping for. So there are shares to meet all types of people's needs. Have a look at our graph. We've seen this graph quite a few times now. So here's our risk across the horizontal axis and our return in the vertical axis. So we've looked at cash and fixed interest, which is our bonds. So as we move up, we're accepting more risk now, and our returns should also be increasing to compensate for that. So we've got Australian shares and then international shares, slightly more risky, but should give us a higher return due to that increase in risk. This is a table showing us how the share market has performed since 2001. Doesn't seem that long ago, but apparently it is 20 years or so. So this is looking at a table of the ASX 200. So that's our top 200 shares in the Australian Stock Exchange. So the best year that we had is in 1986, which is not even in the last 20 odd years. It's back even further. So that was a 52% increase. The worst year is back in 2008, minus 41%. I thought that was quite interesting because I'm old enough to have lived through the last recession, the one in the 90s. It was about 1993, and that was really quite an awful time. But this is actually saying that the worst one was 2008. Now, we didn't have a recession here in Australia then. There was that global financial crisis from the issues with the money lending stemming from America, and spreading around the world. So that is what's caused that 2008 very poor return. So since then, things have improved. Now, I know that my picture is covering up the table with the interesting little pieces of information of what's happened lately. I actually went and updated it too. We had 2020. Now, 2020 is a very interesting year, which you will remember all about with COVID. So we started off the year with the ASX quite high, 6,684. You can see compared to the other years that 2020 was starting off really, really well. By the middle of the year of 2020, it had dropped down to 5,928, but still not that terrible when you look back on the previous years, but it's quite a big drop compared to what the start of the year was. So if you think back to 2020, we had in March, we were starting to work from home. We then had our 6-week lockdown in New South Wales for COVID. People were panicking and the share market was diving down. An excellent time if we had had spare cash then to buy shares. But of course, we were worried about our jobs. A lot of people were losing their jobs, and we were trying to be very protective of our cash. By the end of the year, and end of 2020, the share market had actually come up, and it's only a drop from the start of the year to the end of the year of 97 points, which is, it was only a 1.5% drop. I thought that was very interesting. Think back to 2020. This is a graph showing what's happening with the inflation rates. Now, we had that recession in the early 90s. We managed to skip the recession in 2008, though many other countries around the world were, and we were strongly impacted by the global financial crisis. But in 2020, with COVID, we did have a recession, which was the first one in nearly 20 odd years. So we had a recession, so that's when we have, I think, I can't remember how many quarters are negative. Now here, I've updated it, and we've got the CPI in December. It was actually positive. So by the end of December, we came out of that recession, and the inflation rates are going up. Now this does cause problems when you think about our wages. We haven't had real wage rises for quite a few years now. But if inflation is going up, then that's eating into what the real value of our money is. So you can look this up. I've put the reference here. This is the Reserve Bank of Australia, and you can have a look at this graph yourself if you'd like more information. So what are the advantages of shares? Well, we know that our returns will be higher compared to other investments, compared to putting our cash in a bank account, term deposits, compared to buying bonds, particularly Australian Treasury bonds, which we consider to be very safe. Shares should give us a higher return, and they're a good inflation hedge because their returns are usually higher than the rate of inflation. They're very easy to buy and sell. I've showed you in class the CommSec app. There are many other ways to buy and sell them. It's very simple to do. The transaction cost, the fees have now come down. So I think with CommSec it was $10 a fee up to $1,000, and then I think it's $20 for the next. So quite reasonable fees. There's a lot of information now available, particularly with the access we have to the internet. You can buy a very small number of shares. There can be some rules on this, but if you've only got a small amount of money, for example, maybe $500, as long as that meets the minimum rule, then you can just buy a few shares. It doesn't matter if you buy or sell, but some of them are a lot more expensive than others. So just check that out. So for example, you could have one share that's $200, or you could have a share that's $2, 2 cents. So it is possible to buy and sell just a small number, and there are some tax advantages. Remember, with capital gains tax, after you've held them for a year, you only pay half. So the best thing is to hold on to them. They really should be a long-term thing, not something that you're buying and selling regularly. We've talked about day trading earlier, not to be recommended. Disadvantages? Well, they do have a range of risks. It can be very volatile. The price of them is going up and down. Your dividends are not set. So in 2020, for example, during COVID, businesses stopped paying dividends or reduced their dividend payments down significantly. If you're relying on that as income, then that is going to be extremely painful and difficult. It can be hard to choose. There are a lot of tips out there. I don't recommend, getting the hot tips off the newspaper or from your friends at the barbecue. So you've only got a certain amount of money and you have to pick. You have to give up your money to be able to buy them. So there's no guarantee that you're going to get dividends. There's no guarantee that the value of the share is going to go up at the end. And you do have to pay tax if there's capital gains. You also pay tax on your dividends too. Yeah, don't forget that. It gets added into your tax return. So if you are buying ordinary shares, so that means that you are owning a little part of the company. It's representing equity. You get to participate in the earnings by receiving dividends, as long as it's a dividend paying share. You have voting rights at the AGM. There's no maturity date. Remember, we looked at bonds last week and they have a maturity date, and they can also be called. Whereas with shares, there's no maturity date. You can just keep them. They may buy them back or offer to buy them back. You don't have to accept that. Their shares are easily available to us in the general public. There's an open market, easily bought and sold. So there are two markets, the primary and the secondary market. Okay, so what happens when shares are originally issued is that the company is offering the public to buy them. So they've decided that they're going to list on the stock exchange. They're trying to sell those shares to the public, and they'll list a certain number at a set price. So for example, Medibank Private, what year was that? About 2010, something like that. They listed on the stock exchange. So I happened to have a Medibank Private health fund at the time, and so we were all offered that you could buy shares. So set, and it was $2. I remember that. Yeah, you could buy shares set at $2, and there was just a certain number that you were allowed to buy. So that's a public offering. You can have a rights offering. This is offering new shares, a new issue of shares to existing shareholders. So the number that you get depends on how many you already hold. I didn't quite have this happen, but something a little bit similar in that Wesfarmers, they owned Coles, and they decided to break off Coles to be individually listed on the stock exchange. So depending on the number of Wesfarmers shares that we had, you were then allowed a certain number of Coles shares. There's a little bit of an example of that, but this is actually talking about that Wesfarmers had offered more shares, that they would offer you more in Wesfarmers. It's a little bit different. Private placement, so this is offering private investors or institutions, superannuation funds, for example, they are huge holders of shares. So they're saying to these private institutions, would you like to buy some shares and we'll give you a discount? So this would be limited to 10% of their share capital per annum. Oh, there we go. Here's what I was telling you too early. Stock exchange spin-off. So converting one of a firm's subsidiary to a standalone company by distributing shares in that new company to existence. There we go. I was trying to tell you my story too soon. So this was Wesfarmers share owners. We were actually given shares to Coles. the price of Wesfarmers then dropped because they split that business away from Wesfarmers, but we were compensated by then having shares in Coles, and now we have the two sets of shares. I'm only talking very small numbers of shares here. I think that there's a lot. Okay, so looking at these shares, we've got here Caltex, we've got CSL, AMP, and BOA. Now, we've got BOA is, oh, I don't even, 6 cents. It's not even 6 cents, is it? It's 0.6 of a cent. We've got Caltex trading at $23.79, CSL $233 a share, and AMP $1.64. So, which share would you prefer? I look forward to you telling me in class.